Welcome back, everyone. This week, the primary focus is going to be around a tweet that I saw that talked about how he covered a bunch of his shorts and he's down 9% year to date. Now, we're going to have to get into a couple of things beforehand. And I want to stress that, in my opinion, this is the most important video I've made thus far on this channel and will be one of the most important videos that I ever make on this channel. And the reason is that we're going to discuss people's speech and how that affects their thoughts, and as a consequence, how that affects their action and behavior. And all the fallacious ways, primarily cope and fallacy, that people speak and as a consequence conduct themselves with in regards to the things they say and how that leads to unforced errors, because it is in fact unnecessary. And with that out of the way, let's get into this. And what I'm going to do is there were a bunch of comments that triggered me in regards to this tweet of this individual. I blocked out all the names because I'm not trying to embarrass anyone or call anyone out. This is a human phenomenon that is quite patternable in all categories and dimensions of our existence, whether that's at work, personal relationships, or in investing. And that shouldn't be a surprise because it's a thought pattern, and as a consequence, that transcends all categories. So with that out of the way, let's get into this. Hedge funds rush to unwind bearish stock positions. Global hedge funds rush to unwind bets that U.S.-listed stocks will fall as a persistent rally threatens their performance, J.P. Morgan Chase and Goldman Sachs told clients in reports. For hedge funds, shorts have been a challenge since early June especially. J.P. Morgan said adding the unwinding of short positions got extreme in recent days. Goldman Sachs said in a note on Friday, short covering in the so-called U.S. macro products, which include equity index and exchange-traded funds, reached the largest amount seen since November 2020. Interestingly enough, I actually found out about this article, I think the day after I saw the tweet that we're going to be discussing. And it's interesting because it seems that this individual, it's funny how individuals do individual things based upon their own individual discretion, but we're all patternable creatures to one extent or the other, so it's no coincidence that people come to the same conclusions at roughly the same time because they have roughly the same pain tolerance and or risk tolerance in their portfolios. So even though individuals are making individual decisions, that does not mean that they don't collectively make those decisions as well. A U.S. bull market has caught portfolio managers off guard. Let me stop there. That's relevant because you're going to see in some of these comments how they try to scapegoat retail as to the reason for the stock market going up. And we're going to address this point more coming up. But here is a reputable source, Reuters, talking about Goldman Sachs and J.P. Morgan and what they're saying. So, a U.S. bull market has caught portfolio managers off guard as they positioned earlier in the year for an economic downturn amid interest rate hikes, sticky inflation, and geopolitical tension. Such short covering could in turn give fuel to the equity rally, further complicating the picture for remaining short sellers. Now, interestingly enough, my tea leaves, which is really just to say that people in my echo chamber are actually thinking that the market's going to be going down, which is kind of interesting. Was the final push in this market over the last week or two all these shorts covering, and then that's that? Because we have earnings season coming up in this quarter. And it's just interesting because reputable people that I respect and whose reputation precedes them as far as I'm concerned are betting against this market, both literally or at least putting it out there to be cautionary, which is not something that they do with little thought and consideration. So I'm still long in my portfolio and I'm not short anything, but it's definitely worth for me to pay attention to. The performance of the main U.S. indices however, has challenged their gloomy positions. The Nasdaq skyrocketed over 42% this year, and the S&P surged over 1,700%. While a basket of the most shorted U.S. stocks is up over 40% since early May. The outcome for hedge funds, not retail, the outcome for hedge funds has not been good. Overall, hedge funds went up 3.45% in the first half of the year, lagging the main stock indices. Amid the rally's persistence, investor sentiment has turned more positive. JP Morgan added in its note dated July 13th. Net buying, which excludes stocks sold, reached its largest level since October last year, according to Goldman Sachs. The move, however, was mainly driven by investors buying shares to cover their short positions. All right, that's the bearish or bullish, depending on how you want to look at it, news coverage. Found that very interesting, that the correlation with that with this other individual, who is a large individual, noted. Okay, I don't want you people to leave the video because I'm getting ready to say boring things, because just because something's boring doesn't mean that's not crucially relevant. So I'm going to try to get to these two slides, so then that way we can start manufacturing indignation and talking shit on people talking shit. So and the reason I need to cover this is because a lot of the comments say, which we'll touch upon, a lot of the comments are talking about how things aren't rational, or how they don't make sense, or how it's not logical. But then you have to ask yourself, well, what are they talking about? So you see this slide, false premise. I'm not going to read all this. This is one, I chronically insist that you must question the concepts in a statement as much as the statement itself. So when someone says this market isn't acting rationally, the concept that you have to beg the question of is, what do they mean by rational? Rational in what way? Is there more than one way to be rational? Playing the greater fool theory, for instance, you buying a stock because you think the stock is going to go up more, is completely rational. I mean, that's also kind of what momentum trading is, technical analysis. And that's patternable behavior. And as a consequence, you can logically and rationally deduce things from it with statistical probabilities. I don't know how that's not rational. Now, just because you can't come to terms with your own disillusionment around it doesn't mean anything. That just means that you're behaving irrational. But you as a human being, it's expected for you to behave in that placeholder word called irrational, even though you're actually being a human acting emotionally is being. You should be able to judge that in a rational way and deduce that they are conducting themselves in an emotional way because that's how people behave, and that they post hoc rationalize their feelings in a confirmation bias style way, which means that they use logic to explain and justify their emotion. Now, that's absolutely crucial because, as I said, one of the very important things that I persist on saying about questioning a concept in a statement as much as the statement itself is the following needs just as much emphasis. The logical validity of an argument is a function of its internal consistency, not the truth value of its premise or premises. Okay, you can read the rest of this if you want to. Go to Wikipedia, type in false premise. Arguments. I'm going to go to the second screenshot that I captured here at the bottom. So, let's say that again. The logical validity, because a lot of people are saying this isn't logical what's going on in the markets. Logical validity is a function of its internal consistency, not its truth value. All cups are green. Socrates is a cup. Therefore, Socrates is green. Okay, that is a logical argument. You have to understand this. This will aid you so well in life because most of the time you talk to people and you argue with them. It doesn't matter what it is, political things, COVID things, where you're going to dinner with your partner, your boss, it doesn't matter. What happens is people will select facts and then they will compile them together and then they will find a conclusion. And what you will come to, you'll say that doesn't make sense, or that's stupid, or that's illogical. And you're wrong. The other person's wrong too, but you're wrong on a different level. Because what their argument is internally consistent. The example I always give is penguins. You and a penguin have lungs. You and a penguin have a heart. You and a penguin can produce offspring. Therefore, you're a penguin. Okay? The implication is that you and a penguin are very similar and that you're functionally indifferent to a penguin and or even perhaps a penguin. The statements I made in that argument are facts. That's why when people say I follow the science or those are facts or things like that, they're not lying a lot of times. It's their conclusion that's false. The way they came to their conclusion is truth. And even if it's not all truth, they can have a false premise or a set of false premise that then leads to a conclusion that's also false. But their argument is logically consistent. And you have to understand that. And the way that's applicable to markets is, well, Cathie Woods might be the best example ever. The nonsensical garbage that she says that leads to the conclusions and preposterous, detached from reality things that she comes up with is a consequence of an internally consistent logical argument. It's just that her conclusion is objectively false and isn't true, which is how it tricks people. And I recommend that you do yourself some justice and read up on it. And we're going, now that we've set the stage here, let's get in to the meat of today's piece. So the individual said, covered some bad short. This is going to be the basis for all the comments. Covered some bad shorts today. Fundamentals far from reality. Down 9% year to date. Higher cash level. Okay? That was the tweet that then spawned, I don't know, close to 200 replies. And we're going to cover, 5 slides of 3 apiece. So maybe 15, 20 of those comments. Try not to make this an hour video. I know people don't have much of an attention span. But if you're that type of person, then you've probably either already clicked off of this and, well, my channel is not going to help you if you're of that personality type. But thanks for subscribing and watching to some point at least. Another thing he tweeted was, and I want to address this one right quick. I missed a bunch of things, and since I unfortunately have a brain, the grammar's wrong here, so I'm going to try to fill it in for him. Not to put words in his mouth, but I'm going to. I missed a bunch of things, and since I unfortunately have a brain that looks at valuations, I wouldn't have had chased a lot of the shit that is ripping. Okay. So my initial... Now, I actually like this guy. I want to make this clear. This individual, I thought this was such a good case study and an important example of people that I couldn't help but use it, which is why I then compromised by blocking all the names out. And I actually like this individual. I think he's a good guy, good person, and I believe, could be wrong here, that he is a profitable trader over an iterative sense of experiences. Just because he's down 9% for 6 months in 1 year doesn't mean that he's a bad trader. Just it's volatility of one's portfolio, and sometimes you're not going to get it right, and that's that. And I'm assuming good faith and presuming that's what it is. I believe he's a technical trader around fundamentals. He actually had I don't want to say too much about it. Well, I'll just say he was on Real Vision a few years back and actually provided a trade against shorting FedEx that I found really compelling, and it was a put spread, I believe, and it was actually a beautifully timed call. I can't remember if it was around earnings or not, and that's really all I know. I can't say I've really followed him too closely to really know what he's done in the years since, but I'm using this individual as a placeholder, as well as these comments, which is why their names are irrelevant. So in regards to this second comment, he unfortunately has a brain that looks at valuations and therefore wouldn't have chased a bunch of the crap that's been ripping. Okay, what about the crap that's been ripping that isn't crap? Now, I'd like to think that my portfolio isn't crap, and I don't also know what one means by ripping. Okay, because this is ignoring the counterfactuals. Just like, yes, there is crap that's ripping. Carvana's up like 400% this year, I think. Okay, fine, you didn't chase it because you care about fundamentals and valuations. Okay, what about the things with good valuations? Airline stocks, they're doing quite well, but they kind of dragged their feet for some of the year. Were they not good at good valuations? What about chemical companies? What about coal stocks trading at 2 times cash flow? I would think that there's some sector in the market or subsector, sub-industry, something, some niche place. I mean, Argentina's ripping. It's horribly depressed in valuation, and it looks like things might be turning up with the upcoming elections. Like, what about that part of the market? It's been ripping. I think it's fair to call what's happened in Argentina stocks as ripping. Like, what about that? So, yes, you didn't chase the crap that's been ripping, but what about the stuff that, since you look at valuations, like, why weren't you looking at those valuations? But that's all I have to say on that. So, I'll repeat this tweet one more time, then we'll start getting into the comments. Covered some bad shorts today. Fundamentals far from reality. Down 9% year to date. Higher cash level. Now, the first thing I want to say is fundamentals far from reality. What does that mean? Now, I might be accused of being pedantic in this video, or just in general terms, but sometimes you really have to question the concepts in a statement. And you really have to drill down. The devil's in the details. You have to separate the wheat from the chaff. What do you mean by fundamentals? Fundamentals far from reality. And that's justifying his down 9%. Okay, well, that presupposes that stocks trade on fundamentals and that they always trade on fundamentals. Well, not that they always trade on fundamentals, but that it makes a significant impact, at least most of the time, which means that some of the time it won't. And I guess you just assume that you'll do poorly in the markets when fundamentals are far from reality, right? And yet again, fundamentals, like, I presume that means respectable earnings multiple on stocks reflected in earnings per share and reasonable valued stocks. I guess is what that means. But I just think it's a dangerous proposition to say I'm going to go long something because it's undervalued, or I'm going to go short something because it's overvalued. Because that presupposes that those particular fundamentals are enough to make the stock go up or down, and or that you can position yourself to capitalize on that. Anyway, so into the comments. It's okay, man. People who make money here have to be chasing tech and by definition are retail. Like, what? It's very interesting how people make comments like it's a comment nestled inside of a comment, nestled inside of a comment. So it's okay that you're down this year because those who aren't down this year are chasing tech. So that seemingly is a derogatory implicit statement. And those chasing tech, by definition, I don't know how, are retail. And retail is a euphemism and placeholder word for stupid money. So it's to say, it's okay, you're smart because you're not doing what stupid people are doing. And it's like, and you're smart as a consequence. Like, you are, when juxtaposed to the comparison group, you are smart because they're stupid. Even though I thought smart might be defined by one's own merit and performance, which in this case is down 9%. So, and then this argument is based upon, you guessed it, a false premise, which is why we covered it at the beginning of the video. So you must be chasing tech. Do they not, and by definition, are retail? Which the presupposition that statement is predicated on is that institutional doesn't chase? Well, that's an absurd statement and is more of a proclamation of their ignorance of the industry than it is an observation of reality. Hedge fund managers, well, let me put it to you like this. It's the end of the quarter, or the end of the first half of the year, or close to it, like a month out. So it's February or May, and you're underperforming the market. And you know that if you underperform the market by quarter end, that your investors are going to redeem you. What should you do? Because they're not giving you time to let your thesis play out because the market's crazy. And therefore, it's not your fault, even though you're supposed to be nimble and understand that markets do act irrational and that markets are multifactorial and that they're based upon a lot of things and not just the quote-unquote fundamentals. So what do? Well, you either underperform for the following month, then get redeemed, or you buy the stuff that's going up. Now, why would you buy the stuff that's going up? It's simple game theory, people. Simple game theory. It's either I can stick to my guns and get redeemed and possibly have to shut this fund down, or I can pile in to a bunch of these crap companies that I know I don't want to own, that I don't believe in, that I don't have conviction in, but I know that if they keep going up, it will generate a decent amount, and leverage the position, let's not forget, that it will generate higher returns for me since my names aren't doing well because they're being penalized because all the money, all the fund flows are going in, whether that be from retail or other client or institutional investors, are going into these names, and therefore I won't get redeemed. And if we have a market crash or a correction, I'll lose the money, both from the fundamental names, the core of my book, and I'll also lose a bunch of money from my leveraged tech play, and then I'll get redeemed. But I was going to get redeemed anyway. So it's all upside reward with minimal downside risk, because the downside risk was get redeemed or run a chance of the market correcting and then all your stuff falling a lot and getting redeemed, or possibly survive for another quarter. So don't think for a second that it's just the stupid retail crowd chasing. That's a fallacious argument, and is one that doesn't understand the systemic structure of this game. Okay, next comment. Misery loves company. Glad I wasn't the only one. Quote unquote, quote, buy the worst, end quote, has become a trend again. Okay. So this is a commiserating. You got to understand that people, a primary way that people bond is by talking shit on other people. Now, you'll notice a lot of these comments are against this collective category and group called retail, or collective group that's personified called the market. And how people bond is that they commiserate over injustices that they share that's been unfairly placed upon them. So misery loves company. Glad I wasn't the only one. What that means is he's down money. The other person's down money. So now he's trying to commiserate and engender himself by saying, yeah, these crappy names have been trending again. It's like, yet again, like I said, what about the good names? What about valuable companies that were undervalued, home builders or coal stocks or a lot of the hard asset classes, chemical companies, fertilizer companies, those really haven't been ripping too well, airline companies. Was Meta not too horribly sold off? Well, wasn't it trading at like 9 times earnings or something, and it's cash flowing machine, and they pivoted away from that stupid metaverse thing that, well, that was horrible, but whatever. And like the fact that it went up in price, like it just, yeah, buy the worst, yeah. Crap's getting pumped again, but good names are going up too. Why weren't you in those good names? Maybe they were, but collectively the shorts overwhelmed the good names, and as a consequence, their portfolio's negative. So I don't care for this pair bonding engendering technique either. And by doing so, it only further validates a person and entrenches them in their frame, which is one of a victim mind state. It's an external locus of control. It's not my fault that the market is down. It's other people's fault that they're chasing in a nonsensible or in an irrational way stupid companies. And therefore, I'm a victim to that. That's what that comment says. Now, by the way, everybody will deny all of this because no one ever cites many of the reasons that contribute to people's behavior. How many times in your life have you heard someone say, I did that because of choice supportive bias. I did that because of false attribution error. I did that because of cognitive dissonance. I did that because of psychological reactance. And the answer is never. So then the question becomes, are those never the reasons why people do things? Or are those indeed reasons why people do things, but just never get cited because their conscious is, unaware of it? And that's a worthwhile question to ask. And it also should enlighten you when you ask someone why they did something, whether that's betray you or any other small transgression, that when they provide you with an answer, the probability that that answer is all-inclusive and is a holistic representation of the motives and reasons is practically zero, and that they're going to leave a lot unsaid, which is only going to confuse you, and then you're only going to try to act in the world with partial information that people are representing, and it's not going to go well. Next comment. It is tough to short in this market. It might be worse to short once the Fed begins to lower interest rate. Okay. Let's dissect this. It might be worse to short once the Fed begins to lower interest rates. Now, then one has to ask, why? Because the implicit subtextual communication in that is that the market will go up when the Fed begins to lower interest rates. Now, that presupposes that they will, which I suspect at some point in the future they will. But when, who knows? But then the question is, why? Because interest rate is lower, so therefore it's risk on assets because the discounted cash flow models become better and therefore higher earnings multiples get applied to the stocks and therefore the stock market will go up. Okay, that's true. But hold up. That's not the only truth. See, the problem with most people is it isn't that they don't say true things. It's that they don't say true enough things. If you read a bull case for something, and then go read a bear case for something, and the bull case will not tell you the bear case, and the bear case will not tell you about the bull case. And if they do, they make some straw man, reductionistic, oversimplified case for the other side, which is a confluence of numerous biases acting upon themselves. But it's very interesting. So both cases, the bull case is all true, nothing but facts in it. The bear case is all true, nothing but facts in it, and or honest representation. If your bull case or bear case is based upon future projections, you could reasonably come to a internally consistent logical argument that's objectively false, which is why we covered that at the beginning of the video. And the whole point is for you to be educated on the topic well enough that you can start canceling one another out. Okay, this is the bull case, bulletin point number 8. Okay, but bulletin point number 6 of the bear case cancels that out and contradicts it. How do you resolve the difference between these two statements? Then you critically think and analyze, and then you come up with a sophisticated modeling of the world. Now, we do this a lot of times without giving it any conscious consideration, but the markets require more out of us than normal day-to-day life. So that means now what you've done unconsciously, you say you're cold. I say put your hand on a stove. It'll warm you up. You don't do that. But you just didn't come to that conclusion. You intuitively and subconsciously weighed the risks, the rewards, the pros, the cons. It is a true statement. Putting your hand on a stove will warm you up. It is a true statement. You are cold. And then you cross-compare and analyze and contextualize things, and you realize, yes, that would warm me up, but it's a net negative outcome, and I'm trying to aspire to a net positive outcome. Therefore, I think there's alternative, other better counterfactual means that I can conduct myself in to satisfy my desire to warm up. Now, you did all of that without articulating any of it. You just jumped to the conclusion and said, I'm not going to do that. Instead, I'll take a hot shower. But in the markets, it's more insidious because you can really easily get caught up in burning your hand. So the market, back to this tweet, the market will go up because interest rates go down. But interest rates are a function and a symptom of something else. They're not just going to willy-nilly lower the interest rates, which probably means that the economy is not doing well. And as a consequence is why they're lowering interest rates. Well, if the economy isn't doing well, then don't you think that maybe the earnings multiples will go down instead of going up? It's a very amateur mistake to make. And yet it's being made. Now, I don't know if they're an amateur or not, but it's fallacious reasoning that isn't thinking through all the variables. Next tweet. Not every year can be a plus 50% year. Market is completely irrational. Keep at it. Okay, first part of that's true. Not every year can be a plus 50%. I assume last year this individual had a 50% year, which from a few comments, it looks like that's kind of what happened. So seems like he had a stellar 2022, which is quite impressive, especially if you remember how 2022 played out. Next comment, market is completely irrational. You always need to be on the watch out for absolutist, extremist, binary statements. Completely? Market is completely irrational. Well, first of all, you have to question a few concepts in this statement. What do they mean by market? The market of stocks, the collective market of stocks? Or are they using that as shorthand for the S&P 500? Or are they using that shorthand for the NASDAQ? You're telling me, because to say it's completely irrational, if there's 500 companies in the S&P 500, you're telling me that not a single one of those companies is acting rational? But let's broaden this out, because why limit yourself to just that? You know, what was the U.S. stock market have? 5,000 stocks? I don't think any of the stocks I currently hold are in the S&P 500. So these other thousands, well, you can say the market in aggregate is acting more irrational than rational. That could be a true statement. But see, they didn't want to make a true statement. They wanted to reduce the world down to a lie, to falsehood, to misnomers, to untruths. Now, don't think for a second that doesn't pathologize and warp the orientating mechanism which is known as speech. Because the way you talk affects the way you think, and that affects the way you behave in the world. And by making stupid little comments like that, only ensures that you're going to make stupid little actions like that. And the problem with little things is they compound into big things. Market is completely irrational. Bam, you just condemned the market. Now you've justified your misery and suffering of being down in the market. Let's just say this person is. And you're also no longer looking for the things that aren't acting irrational and capitalizing on them. Like I said, Argentina, multiple stocks. There's multiple industries, sub-industries, and countries that aren't acting irrational as far as I'm concerned. And this completely, it's like they could say markets in general are being irrational, so it's harder to select for specific idiosyncratic asymmetric risk-reward opportunities. There's all kinds of true statements they made. And you could say, well, you're only allowed 280 characters, so it's hard to really convey a thorough thought. Fair enough. But as I just provided two alternative ways that they could have said it that would be allowed within a 280 character confine. Like a person who thinks and speaks will behave similarly. So a person who speaks in absolutist, reductionistic terms, they paint with a broad brush that's conflating categories. Then you make hasty generalizations. It's nothing but cope and fallacy. Next one. For realists, this is one of the toughest years since a while. For realists? You know, it's funny how people cannot come to terms with their disillusionment between the expectations that they have and how the world manifests in front of them. But people are chronically in willful blindness and self-imposed delusion. For realists, let's just say for a moment, okay, for sake of argument, that this market is absolutely irrational, okay? But is it not a rational conclusion to think that the market might be irrational, predicated upon individual actors and agents conducting themselves on an emotional basis, chasing AI and hype and whatever BS, whatever narrative you want to tell yourself about what's causing the market to go up so much so quick? Because you could say, well, look at all those individual actors over there being emotional and doing stupid things. And that's going to result in the tech boom, or the SPAC boom, or this boom, or the rubber boom of the early 1900s, or the pot stock boom of 2017, 18, or the SPAC boom, as I said, or the easy money boom coming out of the March 2020 low, and on and on. You can just look at a boom. There's tons of bubbles. The bubbles is a rational, real expectation of so-called irrational actors. So it is a symptom and consequence of irrational behavior. And as a realist, you should completely understand that. You should have understood that liquidity was easy and Bitcoin is a function of liquidity and risk-on attitude, and that it was being pumped by numerous institutions and investors and retirement accounts and so on and so forth. But the first Bitcoin boom, you could say, that went to 20,000, we're using rough numbers, was caused by retail. And then the second one that came along was caused by institutions. And this third one that might be coming on right now is due to institutions again with all their ETFs and so on and so forth. And to not understand, and that's reality, it manifested itself. Like, how are you going to argue? A realist pragmatically evaluates and analyzes a scenario to come up with probabilistic outcomes. And then that outcome, when it does happen, is reality. I don't know how more real that is. This really should say, for disillusionists, this is one of the toughest years since a while. The market was massively oversold in the October low. And then a lot of people were caught off sides. And then people's lack of understanding, look at Paulo Macro. Go to Twitter, type in Paulo Macro, and look at what they talked about on the RRP and the debt ceiling and how that wasn't going to crash the markets until a later date and so on and so forth. But these people didn't understand the other side of the argument. Now, why couldn't they understand? How did they not understand the other side of the argument? Well, I mean, if you're a realist, then that means you understand reality, which means you understand both the bear case and the bull case. But most of them aren't realists. They're doom and gloomers. And they use selected information in a constrained data set and exclude other information to come up with a narrative, all based on facts, that comes to a false conclusion. And then they get caught off sides. So that's not a realist. A realist would have saw this being a probabilistic outcome. That's one reason why, I'd like to think of myself as a realist. And that's why you've actually seen me hesitantly adding and contributing to stocks in my portfolio, which, by the way, as I said earlier, I do think a market correction of some kind is coming in the next couple of months. So that, I might be pulling my hair out trying to figure out how to deploy capital or not, or what time to deploy, and so on and so forth in the upcoming months. But I've been contributing to names because I suspected that the stocks, the chart just looked bullish from a very rudimentary standpoint. And I was kind of disillusioned too. I can't believe stocks have gone up this much. But you then have to ask, well, why can't you believe it? Retrospectively, looking at the variables that's contributed to the market going up, was that not a foreseeable outcome with some probabilistic confidence value assigned to it? I mean, these are serious questions you have to ask yourself. Okay, next one. As a fundamental investor, I hate this market. Institutional investors are crushing the shorts, driving the market up higher. They'll do it over and over again because there's too much money sloshing around. Good luck. Okay, so here we have an emotional statement, hate this market. What you should probably hate is his poor mental modeling and paradigm that has caused them to be offsides. Because at this point, fundamental investor is a placeholder word for money loser. Yet again, there are a lot of stocks people that are up on the year that are fundamentally sound companies based upon a fundamental value investor standpoint. Look like a Bob Rabati, okay? Great man, I wish you'd do more podcasts. He owns things. He's a value investor insofar as the loosely used word goes. Because, well, just as a quick side note, I was actually thinking about this, value investor, and contrarian value investor. It's like a ego attachment phrase. And I'm like, well, contrarian against what? Well, I guess the consensus, but it's not contrarian against common sense. And then value investor, it's like, you're not a value investor. You're a growth investor, a GARP, growth at a reasonable price. It's like, you're not just a value investor, because then there's this false binary of growth versus value. It's like, well, you're not going to buy a company that isn't growing, and I wouldn't think you'd buy one that's shrinking. Now, I'm not saying that there isn't reasons to do so, because maybe it's so undervalued that at liquidation price, or what is it, net cash asset, net current asset value, NCAV, like Chronos, net current asset value. So current assets minus total liabilities, and it's trading at a discount, which means you could buy it hoping that there'd be a leveraged buyout or something of the company that would then reprice the stock higher because it's trading for such a discount to its assets that a competing company might buy it just to liquidate it and take over the assets because they're trading so cheap. So even though that's a shrinking company, let's say, or even an unprofitable company, there are reasons to buy undervalued things. But for the most part, you want to buy something that's growing, that for some reason is not getting the kind of multiple that other companies might be getting with similar growth because people are discounting the company and or it's too far out, 2, 3, 4 years out, and most markets get priced upon the next quarter or the next year. So you're expecting growth. So it's silly that, so as a fundamental investor, there's plenty of fundamentals. So you're just in the wrong shit. Like, oh, you bought AT&T or something? Oh, you poor guy. Like, I'm not sure. And then institutional investors are crushing the shorts, driving the market up higher. Okay, but it's like, there's also institutional investors, as the Goldman article and JP article pointed out, are also getting crushed. This false binary of all institutional investors do this and all retail does that. It's absurd. Some institutional investors are crushing the shorts, while other institutional investors are being crushed by the institutional investors who are crushing their shorts. It's like, and is retail not participating in also crushing the shorts? But you could say, well, the institutional investors are the outsized money, so on a balance of probability and money, institutional are doing the primary amount of damage. And fair enough. They'll do it all over again because there's too much money sloshing around. Well, damn it, man. If you now know, or maybe you did know, that too much money was sloshing around, that means that things were liquid and easy money. Let's just use that as a synonym, placeholder word for easy money. Well, what do you do in a market? What happens to the market in easy money environments? It goes up. Asset appreciation. The market inflates. So I don't know, as a fundamental investor, you hate this market. If you were doing well, I think you would be post hoc rationalizing why you're doing well because of the unique ability for you to skillfully select names that outperform or something. I mean, I would think so. I'm just thinking that they're losing money. Anyway, next one. Price is the only fundamental. What a stupid thing to say. I mean, you could say that ultimately price is what matters because that's what determines whether you make or lose money. But it's such an absurd platitude that isn't pragmatic or practical. Now, as a person who does believe in respecting price action, this is a problem. This is a factually false, sentimentally true statement. The implicit message of this statement, or that you might infer, is true, but the statement itself is false. It's just unnecessary. It's a real pet peeve of mine that people go out of their way to make false statements when they could just as well make true statements. Don't lift with your back, lift with your knees. I've heard that so many times. It's a factually false statement. Throw your back out and then try to pick something up. And then when you say, oh, it hurts my back, say, just don't use it and use your knees. Like you could say, use your back and your knees. Or you could say, use your thoracic, or use your posterior. You could say, with less words, you could say a more true statement, such as, lift with your back and knees. Or don't forget to engage your knees. That's a cue. Like when people deadlift or squat, they say, chest up. It's a cue. And the point of the cue isn't necessarily to put your chest up. It's to get your spine in a proper biomechanical advantageous position and to help relocate your center of gravity, because to put your chest down causes you to lean forward, which throws off your center of gravity. So by saying a cue like chest up, it then causes you to recenter your center of gravity, and as a consequence, you're more biomechanically advantageous. Now you can say chest up, that's stupid. I'm not even using my chest, I'm using my legs. It's a squat, dummy, but it's missing the point. So I understand it. Price is the only fundamental. Don't trace against priced action. Okay, fair enough. But that isn't to say it's the only. I've talked about absolutist, reductionistic, extreme statements. It's not the only fundamental. There's other things driving the price. And yet again, how does it help you? Am I a better person now that someone has said price is the only fundamental? Am I more intelligent? Can I more intelligently behave in the world as a consequence? I mean, like, and they had a lot more characters. They could have contextualized it, provide nuance, some detail, something. No, not at all. Next one. Everything has its moments. It happens only to the ones who try. You know, this reminds me, when I first read this, it reminded me of that Matt Damon, what was it, Crypto.com, fortune favors the brave. It's like, what a dumb thing to say. Like, is it true? Yeah, it's a true statement. The problem, as I've been pointing out, isn't whether something is a true statement. Once you realize that there's a spectrum, a continuum of truth, how true something is, a multi-trait, multi-model approach, the more true it is, or the less true it is. Fortune favors the brave. True. And you know what else? Poverty favors the brave. So now what? I mean, you know, death favors the brave. A lot of things favor the brave. It gets you nowhere in life to be so foolishly reductionistic in some mean placeholder expression. But people love them. People love their memes. Another one. I've been in the bear camp, and I tell you what, this is my favorite comment, actually, because it kind of hits at home. I've been in the bear camp and out of the market since December 2021. I'm still in decent shape. I don't pretend like I can hit the highs and lows or short, but this time is different. It's creeping into my daily thoughts. I just don't understand it. It makes zero sense. So I guess to get a little personal for a moment, maybe you deserve that if you've been watching this long. I have struggled with interpersonal dynamics most of my life, and still do, And maybe I'm just more cognizant of it than the average individual is, because a lot of people struggle. They don't understand, betrayal, just all kinds of dynamics that play out at work or in relationships or in markets. And I've been here in the markets, and I'd be lying if I said I'm still not here. And somehow some of what I do is faith-based, weirdly enough. This would be an entire video on its own, so I'm not going to drag it out too long. But I'm concerned by this comment because I've been here. I don't understand it. It makes zero sense. There's a saying that I also insist upon. I have probably, maybe I should make a list of axiomatic sayings that I hold as self-evident truths. And one of them is, well, let me just get to the saying. Well, one of the sayings is, things don't make sense until you look at it from a point of view in which it does make sense. Things look stupid until you look at it from a point of view in which it isn't stupid. In life, many a times, you will see someone do something and you will say that's stupid. Well, one of the things you'll find out is that it's actually intelligent what the person is doing, and that they're operating off of perverse incentives, which is why they're probably transgressing against some moral or ethical code that you thought that you and them had a covert agreement on. For instance, you and a partner are dating and they cheat. And you said, it doesn't make sense to me. I love them so much and would do anything for them. I can't believe it. They cheated on me. It makes zero sense. What that is more of a profession of one's ignorance. And more likely than not, that ignorance is a consequence of some ideological narrative that they have of how they think the world should work. Even though the world has demonstrated to them time and time again that it doesn't work that way, and therefore that their expectation is irrational. And I've been in this camp. So I'm not, maybe I'm projecting, but I do find this to be a confident estimation of a lot of people, including myself, because I am a person and those people are persons, and people share a lot in common. And well, you find out, well, it does make sense that you cheated. That, well, they lost respect for you because you acted like a doormat to them, and that they actually are more short-sighted, myopic, caring about immediate gratification and expedience. And that they cheated on you not because of the attractive features, because you might say, I've heard women say this, I can't believe he cheated on me. She's uglier than me. But it's like, well, at least she was putting out. So he had lower standards because he was deprived. So he cheated because he was necessitous. And maybe his ego needed flattered because you're emotionally negligent or physically negligent, which is one and the same. And I'm not trying to, by the way, justify cheating. I'm trying to understand it because I've been cheated on and I've just wondered about it and tried to come to terms with it, to get some, closure. And so you actually find out that there's a lot of reasons and different reasons why different people cheat. So then you go from, I don't understand why they would cheat. It makes zero sense. But then you start understanding all these reasons why they might cheat. Okay, so that helps you improve yourself, such as don't be so necessitous, and that don't take it personally sometimes. And there's a lot of lessons you can derive from it. I don't want to, yet again, focusing too much time on this. It's a presentation in and of itself. And these same principles apply. They're transcendent, as I said earlier, which is why once your speech becomes pathologized, your thought becomes pathologized, and then so does your behavior. And then you're stuck in a doom loop. Like, I can't trust anyone because now I've been cheated on. It's like, well, that's not true. You need to be more cautious in your trusting and more wise and more skeptical and have better selection. Maybe everybody cheats on you. And then, is that because every woman cheats? That's not true. Just look at the base effect, or not base, crap. Just look at the data. It's not true. There's a lot of women that don't cheat, and there's a lot of guys that don't cheat. So you might ask yourself, what is it about you that attracts cheaters? Instead of making hasty generalizations, Remember, I've talked about that paradigm before. Making hasty generalizations and jumping to conclusions predicated on a false premise, you then remove yourself from the dating market, which means that you've now condemned your ideal and have cut yourself off from accessing what you would like out of life, perhaps a marriage and child, let's say, or a companion, all because of false thinking. So, I just don't understand it. It makes zero sense. Well, I would say to this person that they need to further educate themselves. I mean, I could make a whole piece on this tweet. And my heart actually goes out to this person. Like, poor guy or girl. And I've been here. So, anyway, next one. Margin call, question mark. Why not hedge by buying calls or selling puts? I find it fascinating that people who don't know what the hell they're talking about comment on other people's tweets. I only have an ancillary understanding of this individual who posted the initial tweet. And I know he doesn't hedge. He tactically shorts things. He's the best I can understand, a technical trader, technical analysis trader with a fundamental bias. I don't like using that word, but it's pathologized the investing community. It's hard to escape it. So, no, he's not. I mean, he might got a margin call, but he's not hedging. So, like, why are you commenting on a guy's post that you seemingly have just no knowledge about whatsoever? I mean, you could say to virtue signal, look at me. Guy got margin called. Look how smart I am. I understand that there's alternative, smarter, better ways to hedge than buying calls or selling puts. And I'm not really sure. I just noticed this. Why not hedge by buying calls? I think they mean selling calls. Right? Don't they mean by selling calls? Or buying puts? It's definitely selling calls. I mean, I don't buying calls. I'm not sure how buying a call is a hedge. And then selling a put could be a hedge, in a sense, getting you at a lower cost basis for names that you genuinely are interested in getting in. And it also presupposes, by the way, so if you sell calls, if they're covered calls, maybe you actually want to hold on to your investments, though, and you don't want them taken away. So the thing is yeah, I don't, and you would sell it, but if you think the market's going to crash and you want to collect premium from that crash without getting assigned names, you wouldn't sell puts because then you would get assigned unless you roll the puts over. So that presupposes that the initial tweeter was bearish, if you think the market's going to go up, then you would sell puts to collect the premium because you won't get assigned. But he didn't think the market was going up, which is why he was, I presume, short names. So it's just faulty all around. Next tweet. Happens. Play the game. Occasionally get scraped up. Beats not playing at all. Fair enough. Like, there's a lot more that could be said, but I don't want to be that guy. So, like, fair enough, man. Like, play the game. Sometimes you get scraped up. Like, he was bearish. He had good reasons to be bearish. A lot of people were. There's consensus, which could be a red flag in itself, but a lot of times the markets are right. So, and the markets ran pretty hard off the October's lows, and New Year's, you see things play out differently. I think TAN, T-A-N, the ETF, solar ETF, I think when Biden's election year, when he won, that thing just bled off like all year, I think. And you'd be like, well, how is that the case? But it's interesting. New year, new beginnings, themes change, regimes change. So, cool. Next tweet. Nothing makes sense. Reality will set it at some point. Nothing makes sense. You know, it's amazing that people just can't write correctly. If they can't write correctly, do you think that they think correctly? I'm serious. Nothing makes sense. Reality will set in. I'm guessing reality will, so comma, reality will set in at some point. Yeah, there we go. Okay, well, I've already touched upon the reality comment. The reason I put this in, as well as other times, is to show the prevalence of it. Reality, like, isn't that crazy? Like, reality is literally happening. Reality, you need to understand, reality is always set in. Because that's the only freaking option there is. Reality is always reality. You say, well, reality's going to happen. It was like, no, reality, that's the only thing. That's the only thing there is reality. I mean, besides your fictitious, abstract representation of reality, which is an incomplete representation because you exclude information that doesn't reflect the complexity of reality. But that's real too, phenomenologically speaking. It's absurd. Bubbles happen. When a bubble happens, that's reality. Every day, every minute the market's open is reality happening, playing out. That's all there is. A bubble is reality. A bubble is foreseeable. The telecom communications bubble made sense. Why would it not? The rubber boom of the early 1900s made sense. You can't say it doesn't make sense. The SPAC boom, the AI boom, they all make sense, people. It makes sense. It makes sense that a new technology comes to market, is going to revolutionize things. People that are stupid and emotional are going to chase the hell out of it because they think it's the future and it's unlimited because people don't know how to model reality and set their expectations in alignment with reality. So they overbid it. They see price going up. They use confirmation bias and recency bias to buy into it. That feeds on itself to blow off levels, and then some event occurs that then checks them into reality. Asian financial crisis makes sense. I mean, they all make sense. And it is real. And it's real in that it makes sense. Like, that's how people conduct themselves. And the inverse is true when things get priced to ridiculously low levels. Makes sense. People get bearish. When people get bearish, their emotions control them. They more heavily discount the future and overemphasize the recent past and linearly predict and model the future out in perpetuity as a consequence, because that's how humans act, because that's the real representation of humans. Those real humans are acting like real humans do, using real human thought patterns that then manifest in real stock movements and prices. If you don't get that, then, well, I'm sorry, probably shouldn't be playing this game. And your life's not going to do too well. You'll just fumble through life forward with some forward momentum, and the collective stupidity that you demonstrate along with others like you will have the safety net of American primacy and being a first world country with a strong military and reserve currency and individual intelligence making your life better. And, good luck. Next tweet. I hear you, man. It's been a challenging year for people who aren't just chasing. What? What an absurd statement. Aren't just, that aren't chasing. He didn't say aren't chasing. He had that word just in there. And the reason that people use just is to disqualify or to emphasize, to exaggerate. Aren't just chasing. I'm not chasing. I haven't chased this year. Matter of fact, I think uranium should be doing better than it is. The Sprout Physical Uranium Trust is trading at a discount. Their uranium mining stocks have been pretty much sideways all year, even though the thematic fundamentals of the industry are inflecting quite positively. But maybe the stocks are taking a breather because some of that's been priced in and people don't think it's going to last or this or that. So there's other reasons. But it's like, I'm not chasing and I'm doing well this year. I hear you, man. It's been a challenging year for people who aren't just chasing. Well, what about all the passive index investors just buying the SPY every week? They're not chasing. Is every stock in the S&P 500 or the markets globally chasing? It's absurd. It's justification for their underperformance. Post hoc rationalization. It's Copen fallacy. Next tweet. It seldom pays to be rational in an irrational market. Good luck the rest of the year. But a rational acting agent should be able to predict, within reason, an irrational market. And as a consequence, capitalize on that move. It's is it Keynesian beauty pageant? Go Google beauty pageant competition. The sum of it is, who do you think is the most beautiful woman out of these 10 women? And whoever guesses, I just forgot how, I just forgot my own example. You know, someone wins money who do you think will get the most votes? Okay, so something like, who do you think is the most beautiful woman, and which of these women do you think will get the most votes? Now, we as conscious beings know those are two different questions. And so you play the player. Same difference. You're a rational acting agent, knowing that the market's full of irrational acting agents. Some of them are rational, like the institutional investors who don't want redeemed, so they buy the crap companies that pump up the price as a consequence, and so on and so forth, and it's self-feeding positive reinforcement loop. So they're not irrational. Actually, they're very rational. But people will say, well, that's stupid. I can't believe that institutional funds buying NVIDIA at 100 times price to sales. Actually, it's very intelligent that they are, because otherwise, if they didn't, they'd get redeemed. So, yeah, maybe you're the stupid one. So the beauty pageant is, it doesn't matter what you think. What you're trying to do is figure out what the collective culmination and aggregate of people think, and then act accordingly to them. So here you are, a rational agent in the market, trying to determine what the other irrational agents in the market are going to do, and front run them, and as a consequence, benefit from them. That's a more sophisticated development and explanation of the greater fool's theory, by the way. The problem is a lot of times you end up being the fool. So, yeah, it seldom pays to be rational in an irrational market. That's stupid, as they say. But yet again, I understand as a rational agent that they're post hoc rationalizing in a commiserating, self-reinforcing way to validate their own framework of the world and to self-congratulate themselves because they're implicitly, subtextually saying that they're a rational agent, and as a consequence, it seldom pays to play a fool's game. But that presupposes that what's occurring in the markets and every single individual stock in the market is a fool's game, which it's not. So, because irrational market. Notice time and time again how these people are saying market. Well, a market is a collection of individual stocks. So, it could say, it often pays to be rational in a generally irrational market when selectively stock picking. That would also be a true statement, but whatevs. These are the last three. It happens, and thanks for being honest. Hard to tell what to do since the market and fundamentals seem out of sync. Just has to be, another just word, just has to be flow or retail day traders. Really? I already talked about this placeholder, pejorative, derogatory word called retail, and the word just is a disqualifying, dismissive term. Oftentimes, not a merely. So, stupid retail, that's why fundamentals are out of sync with the market. It's like, I think I've belabored the points enough in other examples. It's exactly like Vegas. I'm up 140% since January. Well, it's a nice, humble, non-humble brag. And it's funny because they just, in some sense, probably admitted to being a degenerate gambler, which means that they'll lose that 140%, so you shouldn't be too impressed. It's exactly like Vegas. Wow, that's amazing. Exactly. All you have to do is find one way in which it's not like Vegas, and then they lose. they now are misinformed. This is the problem with making extremist, absolutist statements without any nuance or contextualization and hasty generalizations. And it also, it's condemning your own ideal in a very, the Cain and Abel story is a beautiful thing. Cain destroys his own ideal, which is Abel, because he can't live up to what is required of him from God to conduct himself more appropriately and, as a consequence, get the rewards out of life, i.e. what he wants out of life. So when you condemn your own ideal, what do you have left? Misery, suffering, brooding in some vengeful fantasy of spite. Yeah, that's what happens. And then you can no longer have access to what you want. How many people, I've known poor people who got some money, their parents died or something like that, they get some money, and then they don't really have expenses, so they put their money into a savings account or a CD and let inflation eat away at it. And then I've asked them, I remember saying this before I was involved in the stock markets or anything, and I said, ignorantly enough, why don't you put it in the stock market? The S&P, the index, and they would say investing in the stock market's like gambling. Well, that's it can be. It depends upon the individual participating. Just like there are people that can play blackjack and statistically win because they count cards, which no longer gambling. It's understanding statistical probabilities and distributions of those probabilities and knowing when to go heavy on your bets versus light on your bets and understanding that it's a sequential iterative game. But most people don't conduct themselves that way in the world, which is why they lose. And they are gamblers. But that isn't to say that blackjack is gambling. It's to say, because that's a false statement that's sentimentally true. It's to say that most people who play blackjack are gamblers. Those are two very different statements, because one condemns your own ideal, i.e., because it implicitly, subtextually does so, because the presupposition embedded in that statement covertly is you shouldn't play blackjack because you'll lose money, because to play blackjack is to gamble. That's the conditional proposition and logical argument. The problem is it's based on a false premise. And there's a certain percentage of people who are competent and capable of playing blackjack successfully in given situations, because to play blackjack isn't to play blackjack. It's a lot easier to count cards in a one deck game versus a deck of 52 cards in a one deck game versus a deck of 8, versus how casinos do it and always changing things out because they're making it more hard for the card counters, because in fact you can play blackjack and win and it's not gambling. So here reality is showing and revealing itself to you that blackjack isn't necessarily gambling, and that the proficient, skillful, dedicated, competent individuals can win, because to say gambling is to say that the distribution of outcomes is net negative, and the implication is that you'll lose more money than you make. But that's just not true. It's true for most people. And that's how most people act, is in generalities. But what happens when you're talking to someone that's unique and special? A little snowflake. And then you give them some broad general advice. And you discourage them because they're not yet smart enough to realize the nuances in pretty much everything I've been outlining today. And then you've set them up for failure in life. In an alternative counterfactual universe, they could be a blackjack millionaire. But you dissuaded them in a premature presumption of learned helplessness, and now they'll just be a bum or something else, I don't know. But they could have been a millionaire. But whatever. And finally, markets are irrational AF. We all know what that means. right now. I've touched upon that to an ample, sufficient degree at this point. So to sum this up, talk about cope and fallacy. Talk about cognitive errors, logical fallacies, and biases. This is it playing out in real time. This is the problem with such things is people don't contextualize it to their subcategory and discipline in whatever they're doing, whether that be, IT guy or carpentry or plumbing or fixing cars or anything else, or investing in stocks. This is the kind of ridiculousness you expect, and you can easily be sucked into these traps, for I have said these stupid things myself. Now, I'm speaking in terms because I've already addressed the word stupid, and I'm kind of calling myself out here for saying it, because people don't like my verbose explanations and highly detailed expressions, so I just say stupid as a placeholder word, but I know better. Most people who say stupid don't know better. That's as far and in-depth as their understanding actually goes. Like, my boss can do something, I can then say that's stupid, but I actually understand that they have that outcome that they chose and made a decision on aligns with their perverse incentives and ulterior motives, and that they know that it's a negative externality for me, in which I'll bear the risk and cost of their decision, which they benefit from. It's not stupid, it's actually a very intelligent thing they do. And that they leverage their power and authority to force me and coerce me into suffering the consequences as a result of their decision. It's actually a very logical, intelligent thing for them to do. It's actually the opposite of stupid. But people just rather say stupid and move on with it, and they don't know any better. And you can try to explain to them, and it doesn't matter. They want to be a victim, and so they are, and then they complain about it. All right. Here's my portfolio update. I don't think I added to anything last week. I think I'm up a couple percent, 2 point something, percent for the week, which I really don't like. I am quite, I don't want to say concerned. You got to be careful how you choose your word. It's like saying this trick actually works, because it does. Well, it works for me, and I've read about it, and it's worked for others. So you could say I'm nervous about going on this first date, or I'm nervous about this presentation in front of my boss. But anytime and every time you say nervous, instead say I'm excited. And there's a thing called emotional wheel to help you better articulate how you're feeling and more precisely pinpoint how you actually are feeling. And it really does make a difference. The better you can articulate something, the better you actually feel about it. The better you understand it. It's a funny thing about humans. Seemingly birds and cats don't need that, but we as humans do. And people really sell themselves short on their ability to articulate explicitly something. So is that I'm concerned per se about the market falling in the, I'm thinking August, September. I don't know why. I felt this way for a few months now. I have no rational explanation. I'm sure I could find some post hoc rationalization, but I'm not going to fool myself. I like blue because I like blue, and I think the market's going to drop to some extent. I don't think it's going to drop as much as I want it to, though, whatever that means. So this is all feelings based. But so me making 2% this week is like, wow, impressive. If you annualize that, that's really good returns. But just because the market, S&P, let's call it, sells off, doesn't mean that my names will, but I don't, there's a good chance they will. So it was a good week. I mean, a lot of that had to do with your name. I think I'm 26, 27% cash right now. Gold names ran pretty well this week, so that helped me. Then uranium kind of bounced some. That helped me. Transocean, Tidewater, Valaris, they held their wins, so that helped me. The banking names kind of bounced back a little bit, so So that helped me. And then, would I have thought that Louisiana Pacific would have been... The problem is there's things I'm bullish on that I seemingly... Oh, what's the word? Diddle-dicked around on for too long. And I am kind of concerned that I lost the opportunity of a good cost basis. And home builders, and more specifically, manufacturers and distributors of home building products are one of those. REITs, real estate investment trusts, a couple of them I've been eyeballing. Some of those are up, like Vornado is up 40%. It was around 13. Now it's at like 19, let's call it. And just a couple others have ran hard. And, did I miss my chance? I might have. I invest the way I invest, and that causes me to buy into opportunities at a good time. But it also causes me to barely miss opportunities that would have played out well. But, so be it. I was roughly 5% away from getting into semiconductors at the beginning of the year. 5%. Those things have ran so hard. They would have been my top performer this year. I was like 5%. So me finagling over a 5% cost basis. Retrospectively, you're like, oh my goodness, I can't believe it. And washed out sentiment on the real estate investment trusts, along with time horizon of when I think they might bottom, has kind of been a struggle. And do I get a second chance? Do they double bottom? Yeah, I don't know. And will I deploy capital in that? I don't know. What's the opportunity set at that time? I don't know. So we'll see what happens. With that out of the way, thank you for watching, and until next time.